Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at why a turnaround at the footwear giant Nike is beginning to take hold in North America.
Plus, a look at why Amazon cloud sales may get a push from AI in 2026.
But first, recently on Bloomberg Intelligence, we discuss HBO show Industry.
Industry is a high-stakes drama following young graduates competing for careers in a prestigious London investment bank.
Now in season 4 this year, the bank has folded, and some of these junior bankers have become power players in finance, business, and politics.
For more on the show, we sat down with Mickey Down and Konrad Kay, co-creators, writers, and executive producers of the HBO show Industry. We began by asking Mickey Down about the theme for season 4.
Wow, what a big question. I think the theme of season 4 is, as you said, these characters didn't have power and it was about them accruing power. Now they have power. What do they decide to do with it? And how does it corrupt them? How does it mutate them? And is there a way out of this institution, this life, this industry?
I spent 35 years on Wall Street and many years on the trading desk. You guys get it. I mean, you got it. I don't know how you guys did that. Did you guys work in the financial services industry before, Konrad?
I did, yeah. After I graduated college, I was a US equity sales guy at Morgan Stanley for 3 years. And I was famously, when my boss let me go, he said I was the worst salesman he'd ever met on Wall Street. So he was like, go and do something else because you're pretty useless at this.
Well, that's a true Wall Street career. You haven't had a Wall Street career until you've been fired from Wall Street.
100%.
That's what, and I've been there myself. You guys, what's the state of the industry in London these days? I mean, how are the young people feeling in the industry? Because you guys reflect that with your show very well.
Well, I think our show is a reflection of almost like 10 years ago when we were in it. And I feel like people like me and Konrad would never be allowed in the industry now. I think it's become a lot more technocratic. We both did art subjects.
We were so underqualified, you wouldn't believe it.
We were. I know, I'm not a great mathematician. But I think
you're speaking to a literature graduate and a theologian. So
great.
So derivatives were not, exalted derivatives were not our strong suit.
Only in England is that allowed.
So there's no room for liberal arts majors on Global Wall Street anymore. And what's apparent is the show has become less about banking and more about wealth and resources and the leveraging of that. So,
sure.
Konrad, what are you saying about capitalism and how it interacts with politics, with media?
I don't know. I mean, the thing is that as we've written the show, we've realized that more and more we're writing really about the class system in the UK. Who has power, who doesn't have power, who's born into power, and the sort of relative different glass ceilings people face. Like, I think season 1 was a kind of experiment because they were the main characters were from such different socioeconomic backgrounds that they were always bumping up against different ceilings. And then in terms of, like, me and Mickey never set out every season to say something didactic about capitalism. Like, I think the show has something to say if you're looking underneath it. It has like a very strong subtext, but like we set out to make 8 hours of the most entertaining thing we can. Like 9 p.m. on HBO really means something still. All we care about is entertaining an audience, really.
How is it getting a show on the air these days? There's so many different platforms. It used to be pitched to a handful of networks and hope for the best. Now you can go anywhere on these streaming platforms. How does that impact from the creator's perspective?
Well, I think there are fewer options than there were at least 5 years ago. I think there's been a massive contraction in the industry. I think it's actually much harder to get something on TV than it was when we started. We were two guys, ex-financiers, grandiose term, who were given an opportunity to make something on a relatively small budget by the biggest network, most prestigious network. I just think that wouldn't happen now. I think it's an original show. It's not IP driven. We don't have any fans to service. It's not a comic book. That kind of show, they're few and far between now. And obviously, there are lots of different streaming platforms and lots of different outlets, but I think actually we're just making a lot less stuff.
We were really in the right place at the right time when we started developing the show about 10 years ago, because it was the real gold rush of TV in terms of the amount of content getting created. Netflix came in, disrupted the whole model by flooding the zone with cash and quantity, and we were just in the right place at the right time in some ways.
Season 4 is rolling out right when HBO's parent company, Warner Brothers, is in the middle of a drawn-out bidding war, something that Paul and I have joked about would make a really worthy Sunday night series of its own. Were you ever tempted to draw any parallels between the show and the real-life drama that's going on to your corporate parent?
I think another HBO show already did that.
Yeah, a very successful one that won more Emmys than us. So we'll leave it to them.
Yeah, but you could have made it really meta, for instance.
For sure.
It was surprising they don't consult us on any of that stuff.
Maybe they should.
The other thing that I noticed is that you introduced a lot of new characters this season played by American actors. Kiernan Shipka, formerly of Mad Men, Max Minghella, he's English, but he plays an American character. Why do you put so much of a focus on Americans in London? Given that you're both British, and it takes place in London, it's interesting.
Well, obviously, finance is a global industry. I think, obviously, there's a lot of international people in finance. That was my experience working in the financial services industry. And the show was originally conceived as a kind of outsider status show. It was about someone coming into an inside world, and that was encapsulated by Harper, who's a black American woman coming into the UK, which is obviously rigidly class-based, and that felt really interesting. And we just like we like a mishmash of voices. Obviously people complain about the show and its accents and the amount of different accents that are in the show, but we just love
I think we were consciously thinking of giving an American audience an access point to the show, because as Mickey said, it's a very jargon-heavy show. It's loaded with Britishisms, British slang, British codes of conduct. We wanted to give Americans a bit of a foothold into what we were trying to do.
Just real quickly, who's your audience? What's a typical viewer of your show? I'm drawn to it because I'm a Wall Street guy.
It's very wide. It's very wide
Yep.
in terms of demographically, in terms of age. I'd say it caters to everyone from 18 to 80, really.
It really does. Yeah, my 94-year-old grandmother loves it.
Do Wall Street guys email you guys and
all
say,
the time. Sure, all the time.
What's the number one feedback?
You're getting this wrong, or
you're getting it right.
Or you're getting it right. I could do better, or it's really become a bit of a recruitment tool. People are saying that it's the reason they got into Wall Street. Which
Oh my
is
gosh.
exactly what I wanted.
Well, mine was Wall Street with Michael Douglas and Charlie Sheen. That was my time.
That was mine as well.
That was mine. Our thanks to Mickey Down and Konrad Kay, co-creators, writers, and executive producers of the HBO show Industry.
We move next to the world of sports. With the Super Bowl less than 5 weeks away, the run-up to the big game on February 8th could be a key window for sports betting companies like DraftKings and FanDuel.
According to Bloomberg Intelligence, this time period could allow the companies to expand distribution of the new prediction markets apps available in 17 states.
We're joined by Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst.
We first asked Brian about how DraftKings and FanDuel have been positioning themselves for the NFL playoffs.
Yeah, so DraftKings and FanDuel, among other things, recently rolled out these prediction market apps, which are separate from their sports books. And this is really to compete more head-on against Kalshi and Robinhood and other of these financial firms that offer these event contracts in a number of states.
How big is I'm hearing more and more about this prediction market. How big is this thing?
This is potentially really large. I don't have numbers in front of me, but the key thing is that Kalshi and Robinhood are trying to do this in all 50 states. There are about a dozen states that have either told them cease and desist because they effectively are engaging in illegal sports betting, according to the states, or a couple states have warned DraftKings, FanDuel, don't do the same thing if you've got a sportsbook license. So what DraftKings and FanDuel did was try to go into states with this product where they don't operate sportsbooks. They can do prediction markets on politics or entertainment events in any state, but the real issue is with respect to sports. That's where they limit themselves.
Let me ask you a dumb question, and maybe we don't know the answer to this yet. Who is the target audience for a contract and a prediction market setting versus, just a regular parlay or simple bet in a
so regardless
sportsbook?
of the type of person, in terms of the type of area or territory, think about the fact that you've got mobile sports books in kind of almost 30 states, 30 some odd states, DraftKings, FanDuel, and 25 of them. Other states, big states like Texas and California that don't have legal sports books and sports betting, that's a logical market for Kalshi and for Robinhood to go in there and say, you can do these prediction markets and engage in that even though sports betting isn't active and legal in the state. That's really the big
So what would a Texas and a Florida say about that?
Right. So without going through every state, there are about a dozen states that have either specifically told Kalshi and Polymark or Robinhood, cease and desist, don't do this. A few others have issued letters warning DraftKings and FanDuel do not offer a sports prediction market in a state where you've got a sports bet license. So what FanDuel and DraftKings did is, 17 states for DraftKings, 5 for FanDuel. They're offering this product in states where they don't have sports books and where sports betting isn't, quote, legal.
Who regulates the sports media markets?
So it's very confusing because the sports books are regulated by state gaming regulatory authorities. The prediction markets are regulated by the CFTC. So it's state versus federal. And that's been the argument of Kalshi that, we're a financial futures contract. We're not sports betting. We are federally regulated. The states have pushed back and said, no, this is a form of effectively unlicensed sports betting. And ultimately, I think this heads to the Supreme Court. That's certainly the view of Elliot Stein, our litigation analyst.
So what do the casino companies say these days? What do they say? Does that impact their sports book and their sports betting? And
on the margin, to the extent that MGM and Caesars have mobile products, it's very possible they'll look into this type of product as well, again, in those states where sports betting isn't legal. So everyone's going to think about it. And the real other wrinkle is Texas and California, once they realize we may not have sports betting, we have effectively sports bettors, if you believe that's what prediction markets are, we might as well legalize it. And so there's a whole bunch of ramifications to this.
What about Native American tribes in states like California, in Connecticut? Where do they fit in? How do they fit in?
So it's an issue. I mean, in California, although sports betting isn't legal in California, the tribes have themselves challenged and through legally the likes of Kalshi and Robin Hood, I don't remember which one. So, to the extent that tribes have opportunities to operate sports books, which effectively Florida has the Seminole tribe operating Hard Rock betting site, even though DraftKings, FanDuel are not involved. So the tribes very much will care to the extent that this is effectively a competing product as consumers might perceive it.
So is betting just going crazy, the total dollar amount? I see kids, high school kids, having conversations in detail, showing a level of expertise, which really blows me away.
Shocking, right? Yeah.
Kids, high school kids. And I don't know. It just doesn't feel right.
It's surprising, and it also gets very problematic when you have college kids, college games, college players. So, but there's a big national draw to this, and I think I don't think DraftKings and FanDuel get as affected as some might fear in states where they've got a sports book, but in states where they can't operate a sports book, but Kalshi and Robinhood and Polymarket, others are offering prediction markets. That's where I think they see risk as well as opportunity.
Our thanks to Brian Egger, BI's senior gaming and lodging analyst. Coming up, a look at Bloomberg Intelligence's outlook for North American airlines in 2026.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to research Bloomberg Intelligence recently put out on the footwear giant Nike.
According to BI, Nike's turnaround is beginning to take hold, notably in North America, but China remains a challenge.
For more, we were joined by Poonam Goyal, Senior U.S. e-commerce and retail analyst at Bloomberg Intelligence.
We began by asking Poonam to break down BI's most recent research.
Basically, we think the Nike turnaround is possible. We see finally some light at the end of the tunnel. Their North America business has improved and is going to improve as they rationalize inventories. The issue still is China. And the struggle in China, we don't think will end anytime soon. In my mind, it's a 1 to 2 year turnaround. But that said, if they can get everything else right, which I think they are doing and will get to, I do think that Nike's turnaround is well underway and investors will begin to appreciate it.
So let's dig into the struggles in China. I mean, you're talking about a long time frame here for things to turn around. Is it just that Nike has lost its appeal to the Chinese consumer? Is it competition that's really stepped up in the last couple of years?
So it's a few things. Number one, Nike in the US and other parts of the world is perceived as a more affluent athleisure brand. In China, it is not. What's been happening in China is that Nike has been selling at a discount to clear inventory as the vicious cycle of weaker sales has led to more discounting. So it's more seen as an off-price brand. That needs to change. They know that needs to change. I think that's the first step in solving the problem. And I think what they will do now and what they've said that they do, and I do believe they will because they did it in the US, is they will clean out that aged inventory. But as we know, that will take time. in the US alone in the last year, we've seen that it takes anywhere from 12 to 18 months. The US is finally in a place where in the next 3 to 6 months, they should be clean. So, which is why we think it'll take 18 months. Once they can do that, the new pipeline of products that they're building, I do think will resonate with shoppers and it will sell at full price. But once again, it's an 18 to 24 month turnaround in China, in my view.
Talk to us about new product development and new product introduction. Are there certain verticals they're targeting, whether it's running or lifestyle or, other types of activities?
So running is a core category that they're focused on. They have launched a new innovation in running. Running actually with their new pipeline has done very well. In the US, we saw that running was up nicely, whereas the rest of the business was down slightly to up slightly, depending on the quarter that you look at over the last 12 months. We also think that they're focused on sport. So when you think about Nike, and if you compare it to Adidas, I think there's a big difference in the way that they're approaching their businesses, which allows both of them to succeed. Nike is focused solely and most importantly on sports and performance, whereas Adidas has owned for the last few years the lifestyle category. And I do think that Nike's focus on sports is the right one, and that is where they should be to drive this turnaround.
What about tariffs, Poonam? Tariffs is certainly something that affects Nike. I know that Vietnam and the U.S. has reached a trade deal. Most of the footwear in this country is manufactured in Vietnam. But how is Nike managing through this headwind?
So the headwind is here and it's here to stay. Nike has selectively increased prices to combat the tariff impact. It's also negotiated supplier relationships and found efficiencies internal, just like the rest of the space. Nike isn't alone in the tariff situation. We do think that, tariffs will continue to impact margin in 2026, as well as the shift from DTC to wholesale. The wholesale business is doing better, and Nike is more focused on it today because it had lost focus years ago. So that mix shift is negative. That said, as more full price selling takes hold, as we see signs of China improving over the next 12 to 18 months, those are both areas where they can help to recover lost margin. 2026 calendar year is not a margin story for Nike. It's a top line story. I think 2027 is where we can start to talk about margin expansion.
Poonam, when your discussions with Nike and other consumer products makers and apparel makers, what's the consensus today about the consumer?
The consumer is mixed. The luxury or the affluent consumer is clearly doing better than the low-income consumer. And we do think the consumer will continue to make choices in where they shop. But we think the consumer is looking for fashion. It's looking for newness. It's looking for what's hot in the market. And as long as brands and retailers can be on trend, they will drive sales of those products because that is where the consumer is shopping on trend product.
How much rope are investors willing to give Elliott Hill?
I think you do need to give him another year. We need to give him 6 to 12 months to start to see China inventory moderating and the situation beginning to unfold. For the rest of the world, I think he's proven that things are becoming stable and that they are on the uptick in 2026, especially later in 2026.
Our thanks to Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence.
We move next to research that BI recently put out on North American Airlines in 2026.
According to BI, slowing capacity growth in the first quarter, including cuts from some low-cost carriers, looks set to moderate airfare declines. But weaker economies of scale will likely negate any benefits to profits.
For more, we brought in George Ferguson, our Senior Aerospace, Defense, and Airlines Analyst.
We first asked George about how healthy the airline industry is and what the outlook looks like for 2026.
Look, I think, as we get into 2026 and we're looking at schedules, we're seeing a lot of the growth coming from the big full-service carriers. United especially continues to sort of pour on the gas here and put a lot of capacity in the marketplace. Delta a bit less than them, American even a bit less than them. We're going to have Southwest starting to sell premium seats, and everybody's got a plan for bringing more premium seats to the marketplace. So, when we just look at the full-service carriers, you're going to see 3-4% seat growth in the first half from those big full-service carriers. I think that means there's probably a risk premium seats are going to start to feel some pressure on fares. And that's been, the really big driver of this business, especially for those big full-service carriers. It's been driving their profitability. On the economy end, we're seeing Spirit Airlines there, sort of between this world and that world a little bit. We're trying to figure out if they're going to survive. Might get bought by Frontier. They've dropped a bunch of airplanes. We're seeing some of these carriers cut capacity because of weakness in those seat prices. So I think we'll start to see at least some, firming up of that basic economy as the market tries to get that back in balance. So I think that's what we're going to see in the first half of the new year.
So it sounds like there's going to be a surplus of those premium seats, and then that leaves a big empty hole here for the Frontiers and the Spirits. Are they going to be forced to offer also some kind of premium version of what they currently have on offer?
I don't know. I mean, I think everybody's trying to figure out a way to get more premium in their airplane. They're not forced, but they want that premium travel that's going to just keep flying through through good and bad economic times, and not have the challenges of inflation on their budget and things like that. So I don't know if they're forced, but we're definitely seeing all of them look at ways to increase the price they can get the customer to pay for a seat, whether it's block a middle seat, so it might be 3x3 kind of airplane. They might block the middle seat. Some of them are talking about putting, more recline and nicer seats in the front of the airplane. So I think everybody has a plan for how to get more premium in their airplane. And again, that's going to mean, like everything in the airline business, we'll get offsides on premium before it's all done. I think it begins in the first half. I don't think premium seat prices are going to crater. Unfortunately, we're not going to be able to go anywhere really super cheap flying in front of the airplane in the first half. But I don't think it'll be as good as it was in 2025. Wages.
That's a big cost component for these airlines. I want my pilots happy. I want them feeling like they're well paid. Talk to us about the dynamic in the industry.
Yeah, I mean, look, we still see, I don't know that I want to call it a shortage, but it's a difficult balance between the number of pilots out there and what's needed by the airlines, and the the number of people coming into the industry and getting air transport licenses and things like that. And so the pilots are still decently paid. They came off decades ago. They just had many, many bad years. There was a surplus of them. So they've been catching up, and they got these 20% increases in the last couple of contracts. And in the last contract, we saw a 20% increase and then a 4%, 5%. So actually, it was a 5 and a couple 4s. But 4% salary gains, increases, they're pretty nice in this economy. And the airlines really can't afford that kind of inflation in their cost base. The pilots are a big part of it. And so they keep rolling out bigger airplanes, and that's another challenge in the marketplace, right? Is you put a bigger airplane behind the pilot so you could defray their costs over more seats. You got to fly all those seats into these markets, and sometimes you're discounting more to fill the airplane. So that's a challenge, and continues in the new year. We think the airlines will be managing cost inflation there, in maintenance, in gates, everywhere.
So wages is a big part of airlines' costs, the biggest part, but then fuel is the second biggest, or can be. And jet fuel has actually come down in 2025. Is that going to continue to be a tailwind in 2026?
So, we looked at it recently. We put it out on the Bloomberg Terminal BI space AIRLN. We did some scenario analysis on this. Look, I have a hard time seeing fuel prices dip significantly lower than here, but I am no oil man, right? If I was, I'd own a football team. But I'm no oil man. I don't know necessarily where those prices are going. All I can tell you is if they stick around $2, the airlines had a nice tailwind from fuel. As fuel prices fell, it buffered their margins. If they stick around $2, they probably get a bit of a tailwind in the first quarter, but they're not going to get a lot of gains from fuel. That's not going to buffer their margins.
Did the airlines hedge their fuel exposure? Because, boy, I think I'd be hedging right here if I were CFO.
Not anymore. I think every so often they surprise you. And so I hear what you're saying. Like, you could see one of those crazy CFOs out there going, hey, we might as well hedge here. Could be as good as we get. We saw Southwest do that a number of times in their history and win big. But for the most part recently, what we've seen is almost the entire field does not hedge fuel prices anymore. If you think about it, they kind of sell tickets out 6-8 weeks, so they have sort of a future commitment for fuel prices out that far. If fuel prices rise dramatically, I think everybody in the marketplace adjusts fares fairly quickly because they're not hedged. And so I think, when they look at the pack that they're flying in, maybe the airlines, they think no one else hedging fuel. I'm not going to run the risk to be wrong in a hedge. We'll stay unhedged.
Our thanks to George Ferguson, our in-house senior aerospace defense and airlines analyst. Coming up, we continue with travel and look at how cruise lines may fare against theme parks next year.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence through BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
We move next to research Bloomberg Intelligence recently put out on cruise lines versus theme parks in 2026.
According to BI, Six Flags and United Parks may see more customer visits this year, but this may not equate to in-park spending.
Cruise line customers, by comparison, are booking longer trips further in advance. For more on all of this, we were joined by Jody Lurie, Bloomberg Intelligence Credit Analyst.
We began by asking Jody to give us an analysis on how cruises are performing.
So the cruise lines always have a dedicated base, but cruising is sort of interesting because it's only 2% of the travel industry. Right. It really is such a small portion of it. Where we've been watching is for those new to cruisers, which I don't know if I'm necessarily convinced that they're going as often or they're attracting the new to cruisers, but the cruisers are still very much cruising and they're spending more than the average consumer.
They're also spending more than the people who go to theme parks, according to your research. And partly that might be because the cruise line industry attracts a different kind of customer than the theme park industry. Theme parks skews younger, cruises skew older.
Easy.
Which would you prefer if you are an operator? Which would you prefer if you're an investor?
So we don't make full recommendations, but I will tell you a couple of things based on our research findings. So first of all, you have to think about how people book cruising versus how they book theme parks. Mm-hmm. So when you're talking about cruises, they book far in advance. They book a year or two well in advance. And what the cruise lines have been doing, particularly post-pandemic, is they've been locking people in on the drink packages, on the experiences. They've been giving these steal of deals, excursion ideas. And when you get on the boat, it's more expensive. So people say, okay, I'm going to book my cruise, but I'm also going to book this, the snorkeling, and I'm going to book this, I'm going to book that, the ones that I definitely want to do. They also book the drink packages, which, I think you can go either way on that personally, because I don't think I drink enough, but maybe other people do. And it really sort of just helps their cash flows. Now, theme parks, people book much later. They are younger. They are lower income than the U.S. median household. And the key for them is they can get people in the door, they can get them with season passes, or they can just get them for the one-day pass, but they're not necessarily convincing them to spend in park the same way.
But there's higher volume in theme parks, right?
There's pretty high volume in theme parks, but if they're just paying for the admission, it might not necessarily cover the cost per se, right? They'll get in the door, but they have high CapEx, they have high cost in general, and they have all the employees that they're paying for.
Six Flags, that's a theme park that got some local Jersey flavor here. Six Flags Great Adventure. How's the capital structure for these theme parks?
They are high capex, so high capital intensive companies. Yep. They have high lever
new rides and
right, exactly,
rides.
And similar to cruise lines. So where we sort of see it interesting is theme parks and cruise lines are constantly, they have to get the new experience in, right? So they have to spend not just on maintaining their products, so not just maintaining the ship or maintaining the ride, they also have to get new ones in. So people say, I want to go to Great Adventure because I want to ride Superman, right? Mm-hmm. So they do this to get people excited, draw them in so that they're going. I mean, the biggest example that I don't cover Universal or Comcast, but Universal's new theme park was a big driver to Florida. It wasn't as big as expected necessarily, but it was still pretty big. Now, if you're talking about the regional theme parks, it's a little bit more difficult because people aren't necessarily planning these long-term vacations around Great Adventure.
Do the theme parks attract more domestic consumers than the cruises? I mean, I'm just curious in terms of the sustainability and the stability of your customer base.
So it depends on the brand, because if you look pre-pandemic and now going into a few years post-pandemic, the cruise lines, they segment. So Norwegian, most of their customer base is US. They're US customers. When you get to Royal Caribbean, it's a little bit less. I think it's about 80% for Norwegian. I'm doing this off the top of my head, memory. But 80% Norwegian, you get to about, it's like 70 or 65 for Royal. And then you get to Carnival, and it's even less than that. It's closer to half. It's not quite half that are U.S. versus international. They have a much larger international presence. Brian Egger and I, my equity counterpart, we were on the AIDA, which is one of their brands that they market to international customers, specifically in Germany. And it was a 133 round the world cruise.
Nice.
They were stopping in New York for the day, and they brought a bunch of us equity and credit nerds, and took us around the ship, and everything was in German, as expected, because most of their customers were German. So Carnival has a much more diversified customer base. If you talk about theme parks, SeaWorld or United Parks, as they go by now, their Florida parks, which make up about half their revenue, is international about 10-20%. But when you get to Six Flags, it's much more domestic.
We were off the Amalfi Coast last fall.
Whoa, fancy.
And I saw this big yacht that's like either navy blue or black. And I said, who owns that? He said, it's the Ritz-Carlton.
The Ritz-Carlton, yes. I actually know somebody who went on it.
Just parked in.
Those are small, though. I mean,
They
small
are.
in terms of the
Term
number.
relative
Like
to, like, the
500
world.
people, yeah.
I mean, that looked pretty cool.
Yeah, that's for the people who want to be on a luxury yacht, but don't want to actually own a luxury yacht, right? The joke about
I
boats
see.
is bring on another 1,000, right? My mother-in-law likes to always say that, and that's why it's called boat. So, but the thing about cruising is that there's a perception about who the typical cruiser is, right? It's the older people who are retired, who like to bring basically the Catskills on the water. But really, I mean, it's changed over time. And what's interesting about our credit research and our travel survey that we do every half a year is we're seeing that it's actually really, really spread out. If you look into the buckets that we've segmented, it's really, it's 1/3 of each. So it's 1/3 18 to 34-year-olds, 1/3 that like middle age group, and 55 and older, 1/3. So it's really not specifically the older.
Yep. Our thanks to Jody Lurie, Bloomberg Intelligence Credit Analyst.
We move next to research that Bloomberg Intelligence recently published on the cloud computing platform Amazon Web Services.
According to BI, AWS sales can improve in 2026 by 22.5% in constant currency, or 200 basis points above consensus.
This would be aided by widening enterprise AI adoption and more data center capacity coming online. A potential $10 billion investment in OpenAI could also be another sales catalyst, assuming it comes with more cloud infrastructure commitments.
For more on all of this, I was joined by Anurag Rana, Bloomberg Intelligence Technology Analyst. I first asked Anurag where we are in the growth trajectory of AWS.
When you look at AWS, one of the narratives over the last 2 years has been that they have been a laggard in AI. And large portion of that is because ChatGPT, before the contract change with Microsoft, was only hosted on Microsoft Azure. As the capacity constraints started, Microsoft farmed out some of that business to CoreWeave and then Oracle and so forth. But in the most recent agreement, you can see that ChatGPT can be hosted on other cloud providers. So that's one area to focus on. But the big thing for AWS is it's an enterprise business. It's not so much a consumer chat operate. So this is the year where we think that thing kicks off. And what we are thinking is the growth rate for AWS improves successively every quarter going into the end of the year.
Has Amazon invested in OpenAI or any of that type of thing? Are they part of those, what people refer to as circular deals?
Yeah. So Amazon is not directly invested in OpenAI. They have a new contract with them right now. They have invested in Anthropic. So that's an area where, when you are partnering with the second largest LLM provider, I mean, I'm not counting Google because it's part of a big conglomerate, but a pure play, vendor, which is Anthropic. So they have invested in that. They partner with them. And we think that actually workloads also go up. We recently did an AI survey, and part of what we found out was software companies are using Anthropic more and more, mostly for the coding reasons. And I think if that accelerates, that actually helps out Amazon as well, because some of those workloads do get up to AWS. The big part of the AWS story is it is the largest cloud provider. So the successive growth rate, or to see a big number jump over there, unlike a Google, that has it is the delta is huge, or the growth rates are not the same. So, but what we think this year, some of those enterprise workloads start to flow in as more their capacity comes online. They have invested heavily in data centers, and some of that actually shows up this year, and that we think is going to help them improve their growth rates.
So from a competitive landscape position, how do you think of AWS in the AI space?
Yeah. So when you look at the traditional space, they are the clear leader. But when you look at the AI infrastructure space, that lead is starting with Microsoft because they got ChatGPT to begin with. So that's one. Then you have Google doing very well with their TPU stuff. Oracle and CoreWeave also getting into that. But Amazon still has a very large portfolio over there. And what we think is going to happen this year is they have been spending a lot of money to expand that data centers. They're going to get more and more AI infrastructure orders because, at the end of the day, they have the capital. They also get the same chips from NVIDIA. They have the luxury or the know-how to build those data centers and plug these things together. So I think this is the year where they kind of break through from a lot of this narrative of being an AI laggard.
And that's kind of reflected in the stock, Anurag. I'm just looking at over the trailing 12 months, only up about 5%. Is the reason because they just haven't necessarily got the full AI, kind of win in their sail?
No, because the kind of work they're doing is very different. The first phase of AI boom that we have seen is in the consumer app. It's in the ChatGPT and the Gemini, what we have seen. They're not enterprises. They're not large banks that are, adding more AI capabilities. But we are in that phase of enterprising adding more AI capabilities. And when that happens, they have the large infrastructure, plus they have a lot of the data that these big companies reside in the Amazon ecosystem. I think that's where they benefit the most.
I mean, it's not very often in the last, 15 years where we could say Amazon is cheap or Amazon looks like a good buy relative to its peer set. But I mean, if you have a certain time horizon, is that what the bulls are saying here?
Yeah, I think that's where it is that, so far the narrative has only been about OpenAI and ChatGPT and Microsoft. I think that narrative starts to change this year with more and more enterprise adoption. And, you and I talked about it just a few weeks ago that we did an AI survey where enterprises are really looking forward to deploy some of these AI tools internally. And that's not going to happen in isolation. They have to build that on some data framework, some kind of AI framework. And that's where AWS comes in.
Our thanks to Anurag Rana, Bloomberg Intelligence Technology Analyst.
That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.